Hello everyone, I am Osima Biswal. Today I will discuss about a comparison between public finance and private finance. If you like my video, please subscribe my channel Economic Tech. Okay, first I will discuss about the similarities between public finance and private finance. Similarities. First, same objective of satisfying human wants. Okay, private finance is the finance of private household and public finance is the finance of public household. Okay, private finance aims at satisfying private or individual wants with the limited resources available at their disposal. Public household finance satisfies public wants or collective wants with the available resources. Satisfaction of human wants is the essential objective of both the public and private wants. Second, both the finance follows the principle of economic rationality. Economic rationality demands to maximize personal benefits with the available resources. Third, both the public and private finance try to balance their income and expenditure. Both finances borrow to make up their deficits when they find that current income is insufficient to meet their current expenditure. Okay. For distribution of income, in both the cases of finance, scarcity of resources is a common factor. Therefore, an individual distributes his expenditure on various commodities and services on the principle that the marginal utilities of all these expenditures are equal and total utility of the whole expenditure are maximum. A public authority similarly acts on the principle that marginal utility to the society of all forms of public expenditure is equal. And 5, public and private finances do business for profits. Public sectors operate business with the aim of earning profit. Private sectors also operate business with the aim of raising profit. Cost profit studies are made with the aim of getting higher profit. In view of these similarities, one may be led to think that both the finances operate on the same principle. Public finance is nothing but an extension of private finance. But this is not true. Behind the similarities, the dissimilarities are all the more sharp. Okay. Then I will discuss about the differences between public finance and private finance. First, adjustment of income and expenditure. The difference between private and public finance arises on the adjustment of income and expenditure. While an individual adjusts expenditure to income, public authorities income to expenditure. An individual determines his expenditure. In case of public authorities, their expenditure determines their income. Okay. An individual always tries to live within his income and adjust his expenses the size of his income. He coats his coat according to his cloth. On the other hand, public authorities first decide the size of their coat and then find the necessary cloth for it. The public authorities decide the various items of their expenditure and then find out the income to meet the expenditure. This difference in approach arises because the individual knows the size of his income while the government does not know it. So the government decides the activities it will undertake and expenses necessary for them, and then finds out the ways and means to meet this expenditure. Okay, for this some case the difference is not applicable. Why? Sometimes the individual first decide about their expenditure and then find out the necessary income, so that when he has number of children he works hard. When the children become self-supporting, he works less and enjoys more leisure. Similarly, at times also government adjusts its expenditure to income. In bad times, the government may reduce expenditure, okay, by reducing so as to remain within his income. Public authorities cannot increase their expenditure indefinitely. Okay. Then second, compulsory character. Second difference between public finance and private finance is compulsory character. Public financial authority can use compulsory methods to earn income and incur expenditure, while payments of taxes are always obligatory and refusal to pay a tax is punishable under law. Similarly, when a public expenditure is incurred on a project, everybody is bound to use it. Private individual business cannot force a person to get their income forcibly. That is why it is said that public income is always certain, private income is always uncertain. Third difference between public finance and private finance is motives of expenditure. Private finance have always the motive of personal profit and benefit. They always want to spend less and get more. But in case of public finance, the motive of public expenditure is social welfare. The government spends on the improvement of general nature, where either profit motive is absent or uncertain. The government spends on public health and higher education not for profit but for the public welfare. In certain commercial activities where private business does not come to invest, government invest. Hence profit is uncertain. Third difference is method of financing expenditure. Individuals have limited resources at their disposal, whereas public authorities can draw upon the entire wealth of the commodity. In case the deficit, public authorities can borrow from citizens of the country, from foreign countries, and finally under difficult circumstances can print more notes to meet their deficits. Individual cannot raise internal loans, nor can print more notes, nor can compel individuals to pay more taxes. They depend upon their external borrowings and past savings. Okay. Here, methods of budgeting. In the preparation of their budget, both private finance and public finance differ from each other. The public authorities prepare their budget for a year, whereas individuals prepare their budget over a long period. Secondly, in case of individuals, their surplus budget is virtue and is always preferred. Individual saving is a virtue because through saving he can accumulate capital and then can become rich. But a surplus budget is not beneficial for public authority. Government normally prefers a balanced budget, but during the time of depression, when there is more of unemployment in the country, government spend more and prefer a deficit budget to stimulate demand, production, investment and employment in the country. In developing countries like India, deficit budgets are restricted to uncertain development works. Then, sixth difference is that principle of equi-marginal utility. Individual and government finances try to maximize satisfaction by distributing their income in such a manner that the marginal utility of money spent on each item of the expenditure would be equal. This is otherwise known as the application of the principle of equi-marginal utility. Some people argue that individuals can apply the principle better than the government. Government consists of a large number of persons. They are many times influenced by non-economic considerations. There are regional pools and pools. The legislators have to yield to the local demand where it is economically sound or not. In case of individuals, there is scale of preferences, but while spending on defense, education and flood relief, the government is forced to spend without any scale of preference. The government has no freedom in respect of these expenditures. Therefore, the principle of equi-marginal utility is better applied in case of private finance than in case of public finance. But individuals are also subject to pressure like state. His expenditure is influenced by his children, relatives, neighbors and enemies. He spends unnecessarily on social ceremonies and avoid expenditures on necessaries. Here the principle of equi-marginal utility cannot be applied easily. Then provision for the future. The next difference is that the provision for the future. The individual keeps little provision for the future, but the government spends large amount of money for the provision on the future. The individual feels present needs more strongly and underestimate the future. He lives for the present because he knows yesterday has gone and who knows what will happen in unborn tomorrow. But government is not short-lived. It is a permanent organization. It is the custodian of the present and future generations, so it spends money for the promotion of the future interest, preservation of forests and wild animals, and exploration of minerals like coal, oil, and conservation of soil and construction of irrigation channels draw heavily on public finance. These are long-term projects which no private capitalist will undertake. For the government, future is as important as present. The next difference is that private finance is secret and public finance is public. Okay. The financial transaction of an individual is secret and the government and often affair. Okay. Their government budget is always give wide publicity. It is issued and voted in the parliament. Every citizen of the country should know what is happening to the taxpayers' money. But the income and expenditure of an individual is always a secret affair and is not open to public audit. Then the next difference is that individual finance has little effect on the country as a whole. Individual income and expenditure don't have much of effect on the country, but the government financial policy affects the total economy of the country by raising income and price levels. From the above analysis, it is clear that the principles which govern private finance are different from the principles which operate in case of public finance. The most important reason for such difference is that public finance sells public goods or social goods while private finance sells private goods. So these are the similarities and difference between public finance and private finance. Thanks for watching.